So, hi everybody, this is Hustle Hub. I'm Giacomo, and today I'm with our special guest. He is Marc Chandler. He has been a reoccurring guest on Bloomberg TV and other TV stations. So please, Marc, introduce yourself, tell us what you do, and then we'll jump into the topics of today.
Great, yeah, thanks for having me. So my name is Marc Chandler. I've spent a career on Wall Street, in particular in the foreign exchange market, which I still, even after 30 years, I still am very enthusiastic about it because it's the biggest of all the capital markets. Average daily turnover, $6.5 trillion. It's really a mind-boggling number. $6.5 trillion a day means that in 1 week, the turnover in the foreign exchange market is enough to cover world trade for a year. So I spend my days watching the markets and working with clients, sometimes asset managers, sometimes corporations, to help navigate the sort of the complexities, if you will, of the foreign exchange market.
Okay. So he has his own blog, and he talks about mainly macroeconomics. So today we're going to talk about the current situation in the markets, and we are going to talk about economic policy, and then we'll jump into the markets and we'll take a look at what are the asset classes that are going to be hit by the current situation and what are the kind of assets that could help investors ride this current situation, let's say. So we came out of today with the ECB meeting. Can you sum up what Christine Lagarde said, and what does that mean for the markets looking forward?
Sure, yeah, it was kind of interesting today because when the ECB first released its statement, and they indicated that they were going to slow down the asset purchases, the market took the euro sharply higher. You know, when we began this week, the euro was trading, got down to about 108, and today we got above 111. Helped by this seemingly more hawkish stance than most people had expected. Now, I personally had expected, I wrote about it, about what the ECB was going to do with the asset purchases. But once Lagarde began talking, the euro sold off, and it made new lows. So we got well above 111 on the statement, but then when Lagarde began talking, we began selling off, and the euro fell below 110. And so it was a big move today, partly because of this communication challenge. And the communication challenge is something like this. Same problem we had in the US. The central banks recognize that there's a great amount of uncertainty. Oil prices, the war, what's going to happen to wages, excuse me. And so with this great degree of uncertainty, Lagarde, like other central bankers, wants to preserve a maximum amount of flexibility. And so to preserve that maximum flexibility means to take off the handcuffs. What were the handcuffs for the ECB? Asset purchases. Because we know the sequence of events. Asset purchases will stop, and then, and only then, will interest rates rise. Same thing in the US. The Federal Reserve had to stop expanding its balance sheet by buying assets, and then, probably next week, the Federal Reserve raises rates. The ECB, though, it's more complicated because even before the pandemic, the ECB was engaged in quantitative easing, buying bonds under this program called the Asset Purchase Program. But when COVID struck, the ECB launched a new facility called the Pandemic Emergency Purchase Program. Well, that program is winding down. COVID is winding down. That emergency program is winding down. So what they did was they were going to double the size of the former program, the Asset Purchase Program. So that went from 20 billion to 40 billion. And it looked like 2 months ago, that the ECB was going to continue to buy bonds through all of this year. But that meant that if they did that, it meant that they couldn't raise rates if they wanted to towards the end of this year. And so today, what the ECB did was they basically changed two things. They changed the pace of the asset purchases. So they're going to slow down quicker than people had previously anticipated. 40 billion in the month of April, 30 billion in May, 20 billion in June. What do they do in Q3? Lagarde says it's not time dependent, but data dependent. So theoretically, the ECB could stop buying bonds in Q3, lead to a rate hike in Q4. And that's sort of the baseline view, I think, in the market. But the ECB also, to preserve this flexibility, to secure the flexibility, what the ECB had previously said was that the rates would rise shortly after after they were done buying bonds. Today, they changed that from shortly to some time. So that again, we don't really know anything more than we did before, except that the ECB's got greater flexibility. Short term would seem to be 1 or 2 months, but now sometime could be even a rate hike even into next year. So the market has responded to these asset purchase program plans and the changing of wording. The ECB also changed its forecast a little bit, as you would expect, higher inflation. And they took this year's inflation to 5.1% from, say, the high 3%. So they recognize greater price pressures. And they also shaved growth for this year from 4.2% to 3.7%. And so the image that we get, and this is also we're going to get from probably the Federal Reserve next week, is that it's like the recent developments are like a scissors. It has 2 blades. One blade is inflation, it's going to be stronger. The other blade is growth, and it's going to be weaker. And we have to navigate that as both investors, but also policymakers have to navigate both blades of the scissors.
Okay. Yeah, so one big problem right now, as you said, is the possibility of low growth and high inflation or stagflation, so a sort of environment like that. So talking about the current situation in Ukraine and so on, what are the kind of markets that are going to be hit the most by the current situations in the commodities market, and how the growth will impact, for example, Europe, the US, and so on? Do you have an idea on that?
Yeah, so here's the issue that's happening. Even before the Russian invasion of Ukraine, there were supply disruptions. Oil prices were already rallying. And so what this has happened is that because of the war, oil prices have rallied even further. Natural gas prices have rallied, and you see this really very pronounced in Europe. And so the commodities that are most hit are those that seem to be most disrupted by Ukraine, Russia. So this would be oil, natural gas, wheat. Just yesterday, the U.S. Department of Agriculture revised up its forecast for how much wheat supply there is. And so when you have greater supply, the price fell sharply after a huge rally. But we have to think about, what does Russia, Ukraine make that the world needs? One of the big things is not just what they produce, but also where it goes to. For example, the Middle East buys a lot of wheat and sunflower oil from Ukraine and Russia. And with this disruption, or higher prices, people are worried that's going to lead to some greater political distress. But so we look through the other like commodities and things that Russia produces and Ukraine produces. Another thing that's very important is fertilizer. And so this is really going to hurt a lot of countries that many countries in Europe, European farmers depend on this fertilizer, potash, but also when you think about the ingredients in fertilizer, natural gas. Natural gas is in the pesticides. The oil, the carbon is really in the fertilizer. And so we see a big disruption here, higher food prices, which might be okay for us city dwellers, but for a lot of rural people, higher food prices it's very expensive, and it hurts lower and middle income families. It's really a regressive tax, and so it really slows down. The more you have to spend to feed your family, the less money you have for discretionary spending.
Okay.
But also we think about like what's been safe, what's a safe place for people to go. And I think that there's been a couple of things that we've seen because it's a big commodity boom, big commodity rally. We've seen countries like Australia, the Australian dollar, the New Zealand dollar, the Brazilian real strengthen. We've seen the Swiss franc strengthen against the euro in the currency markets. But the other thing that's happening in the currency markets is the proximity to the conflict. So Central European countries like Hungary, Poland raised rates more than the market had expected in the last week or so. And yet the currencies have been hit very hard. One interesting speculative play that people are doing is they sort of see Hungary, Poland, even Czech as maybe high beta versions of the euro. By high beta, I mean it does whatever the euro does, but more so. So being long the Swiss franc and short the Hungarian forint, for example, is an interesting speculative play trying to capture both sides of that, the safety of the Swiss franc and the risk of Hungary. But there's something else too that is an interesting barometer of the stress in the system, and that is the spread between Italian bonds and German bunds. And after the ECB meeting today, the Italian bond sold off very hard. The yield on the 10-year bond rose over 20 basis points, while the German bund increased only about 5 basis points. So that spread, that premium that Italy is forced to pay over Germany, is another measure of the stress in the system. So someone who's looking for a place to hide out and try to weather the storm, keeping in mind the preservation of capital is so important, bunds over BTPs.
Okay. And another thing that comes to mind when we're talking about commodities, and do you think are Middle Eastern countries going to supply more commodities in order to make up for the missing commodities that we won't buy from Russia, for example? Do they have more capacity than compared to now, and will they be willing to deliver?
Yeah, isn't this interesting? Because you've seen so many parts of the world pull out, isolate Russia, but the OPEC plus, that's what we call OPEC plus, these non-OPEC countries, especially Russia, and they're still sticking with their plan of just letting another 400,000 barrels a day go into the market. And to your point, many of those countries do not have the capacity to even meet their current quotas. But there are two countries that do within that OPEC plus group, Saudi Arabia and the UAE. Earlier, the UAE suggested they might be interested in boosting output, but they were really strong pushback against it. The key, of course, is Saudi Arabia. And I think that at least right now, and by right now, I mean not only like today, but probably we won't get another window of opportunity until early next month for the Saudis to break from Russia. And it's a hard thing to. Saudi Arabia is in a tough position, right? Here we are, Western Europe, U.S., many high-income countries, and we're thinking about alternatives. Many of our asset managers, people who are managing our pension funds, have to think about ESG, environment, social, governing issues when they make these investments. And so we in the West, high-income countries, are pulling money out of. We're reluctant to invest in the sin companies, the polluters, the oil companies. And this is limiting the capacity, the growth of the capacity. So, for example, Russia exports something on the magnitude of 5 to 6 million barrels of oil and oil products, leaving aside natural gas. And even if OPEC wanted to, it's hard for me to see how they're going to be able to make up for all of that. And so, given that there's going to be a shortage, two things happen, right? One is many people become more conservation minded. In the U.S., many people still drive these SUV, these huge vehicles that are huge gas guzzlers. And I say that because I'm very proud of the fact that the car I drive is a hybrid, and I get 60 miles to the gallon. My friends struggle to get 20 miles to the gallon in these huge vehicles. And so I think, one, we become more conservation minded. Secondly, I think that the price is going to have to go up. When you have a scarce resource, in this case, oil, to allocate it, you raise the price. And the problem with the higher price of oil is that oil is unlike other things. If the price of shoes goes up, maybe we buy less shoes. But oil is less. The demand is less sensitive to the price. And so what happens is that put it like this: in the last 3 business downturns in the U.S., the last 3 recessions were preceded by a doubling of the price of oil. So the price of oil, yes, it boosts inflation measures, and Lagarde today was talking about that. But what it really does is it slows down the economy. I'll give you the rule of thumb that our Federal Reserve Chairman Powell gave a couple of weeks ago. He said for every $10 a barrel oil price increases. It boosts US inflation by about 0.2 and shaves about 0.1 from growth.
Okay.
And so it's not just a spike, right? But you take like a moving average, like a 4-week average or something, really get like what's the real price on these kind of measures. And so we're looking at higher inflation. The US inflation today got almost up to 8%. And I think what this means is that we're going to have inflation longer and higher than before. So if before people like me were thinking that maybe inflation could peak in the next couple of months, and now we're thinking maybe not until late this year. We were thinking inflation could peak, say 7 to 8%. And now I hear even people talking about 10% inflation.
Okay. I want to mention something that you have briefly talked about before, that came to my mind. So is the denial of capital towards what you called the polluters with ESG policies working against us right now?
Yeah, it's interesting. I think here's how it works against us: is that many of us have pension money, or in the U.S. 401k money, and how are these managers going to invest it? That we give money from our paychecks, or we put money aside, and they're supposed to invest it for us. And increasingly, their portfolio is not just about rates of return or risk-adjusted returns, but it's also they have to meet certain internally imposed ESG requirements. So if you have oil investments, then you need to offset that with something else. And so I do think that for various reasons, the old energy intensive sectors, oil, have been seeing marginal new investment. And that means that they can't expand capacity. But at the same time, in the US, it's not just that we have the fracking geological formations, but we needed other things to really exploit that. One was cheap capital, because it takes a lot of money to do these kinds of things and innovate. And so we had the geological formations, cheap capital, but we needed something else. And that was a disregard for the environment. And I say that because New York State, for example, has some fracking formations. But the voters in New York said, no fracking. And they did this for environmental reasons, not because of, so you have, say, fear and greed as the two big emotions. They were less greedy and more afraid of the damage they do to the environment. And so I think that kind of logic keeps people from investing, putting more money into fracking, but that cheap money has also dried up because of the problems. Back when the pandemic first struck, the price of oil in the US, like Brent crude, fell below zero. Imagine that. You have to pay someone to take away that oil from you. Imagine that. It's just like mind-boggling. And so to make up for those losses, those people who gave money to, say, our fracking industry, they say they want a return on their investment. So before these frackers begin expanding output and take advantage of the $120 a barrel of oil, they have to pay back the shareholders. And so the shareholders are getting higher dividends. They're getting stock buybacks. So rather than expand capacity, there's several reasons why, in the US at least, they're not expanding capacity. And the same story to a lesser extent is in many Middle East countries, where they have not kept up with the investment that's needed in the oil sector. And so they too can't really expand capacity. Okay.
So basically we are denying capital to for example, to the oil business, because we want, let's say, a greener future, but we're not there yet with the technology for renewable energy. Okay. So another question that I have, what is your point on companies divesting from Russia, and could there be something like a disruption of capital flows that came from Russia? Aside from that, could that have a contagion on, for example, European banks that were invested in Russia and other relevant companies that were invested in Russia?
Isn't this amazing? Russia goes into Georgia in 2008, and we cry about it, we whine about it, but we don't do anything about it. Then Russia goes takes a piece of Ukraine, Crimea, in 2014. We whine about it, we cry about it, but we still don't do anything about it. Now, and it seems rational, I mean, in some ways, that Putin says, well, they're not going to do anything this time. People like myself who watch these things and look for these historical patterns and say, the West isn't going to do anything. And yet here we are with not only governments sanctioning banks, the rich people, the oligarchs, companies, but also the private sector has really jumped in a way that seems to me to be unprecedented. Companies like consumer goods companies, McDonald's, Disney, Coca-Cola, Pepsi, but they're not just US companies either. Sony, many European sort of high-end fashion, like, those kind of labels are pulling out. We're seeing widespread, but so the question I think to me is, yes, there's going to be some financial hit. British Petroleum selling its asset in trying to get rid of its asset in Russia. These things are going to come at a cost to these corporates. One has to ask, like, why were they there in the first place? But I'll give you another example. I think Goldman Sachs says today they're going to pull out of Russia.
Yeah, that's right.
I think this is the third time they've said it. I mean, they say it every few years when Russia does something stupid, and they pull out, and then they go back in. And it sort of reminds me a little bit about what Lenin said about that the capitalists will sell them the rope to hang them.
Okay.
That we I don't know why we do this, but we do this. And but I think that the issue is that, and even with the bank exposures, of course, there will be some banks that get hit with this. Hit hard as they have to write down their portfolio. Russian bonds, I mean, they look like we're trading them as if they're on the verge of default. And so there's money tied up in this, of course. But it's really the issue is whether it raised to the systemic level. So that is, a couple companies will be hurt, some banks will be hurt. Yes, it's true. But will it require a policy response the way, say, long-term capital did, or the way that the Greek debt crisis did in 2009, 2010, or the U.S. The mortgage problem the U.S. had 2008, 2009. And my sense is that it's not going to reach that level.
Okay.
That is going to be hurt. In part, it's going to hurt, but it's not going to rise to the level of systemic issues.
Okay. It's good to understand what kind of degree that is a problem for our Western, let's say, financial system. So great. Even though it's a very volatile situation, and every day we get updates and so on, but do you have an idea of what are the first of all, what are the currencies that are going to strengthen, and what are the currencies that are going to weaken given this situation, and what are the kind of asset classes that are going to benefit, and what are the kind of assets that are going to lose out of this situation the most? Do you have an idea on that?
Yeah, so it's hard to think of asset classes that are going to do well. I mean, but there are some things that stand out. So when you think about partly it's really like looking at not just the sort of look, I guess we call it the first derivative. So you say, well, commodity prices are going to go up. Well, so you buy commodity producers. Who are the commodity producers? Well, Australia, New Zealand, Brazil, Latin America, say over East Asia, for example. Right? East Asia are big commodity importers. And that's what we've seen also, think about asset classes, really since the start of this year, but it's really intensified lately. Foreign investors have been selling Asian equities. What have they been buying? A little bit of Chinese equities, but Brazilian equities, South American equities, because when you look at those stock markets, they're not so diversified the way, say, the Italian stock market is, or the way the US stock market is. But a lot of those Latin American stock markets are dominated by the large companies in the commodity space. I think that the Swiss franc has done fairly well. The Japanese yen has done until recently fairly well. People think of them as safe havens, but I think it's a bit of a misnomer, because what typically happens in the financial markets is you don't use your own money, you're using other people's money, OPM. And so in effect, what people do in the sort of financial structure of trades, they borrow the yen, because they can practically borrow the yen for nothing. And then they sell the yen and buy something else with those proceeds, like emerging markets. So when the emerging markets get hit, people sell off the emerging markets, and they got to buy back what we call the funding currency. Japanese yen, Swiss franc, the US dollar. So, but in this current environment, I'd say that what most of us probably are best served doing is keeping our gunpowder dry, waiting for the stock markets to burn themselves out, and they price in all the bad news. So much uncertainty now, and it's almost like trying to catch a falling knife. So I think that we're best served by recognizing that it's next to impossible to do, and wait. We don't have to be the first ones to jump into the market and say, okay, now we're going to buy. Let other people with deeper pockets go first. It's sort of like watching in the U.S. People watch a lot of these poker games, and the person who's at a disadvantage in the poker games is always the one who's got the least money. We say the short stack. That's what we are as retail investors in this huge capital markets. So I'd say preserve capital, and that's always the first rule, right? We say that sometimes the return on your money is not as important as the return of your money. So capital preservation is key, and there's preserved by primarily staying in cash or very liquid instruments, waiting for the opportunity when you think it's the best opportunity. And for me, I'd say when the stock market stops falling, you might not be the first one in under this idea, but you're not going to be the last one in, and you have the capital to be able to participate. But also some people like gold in this environment as a safe haven. Problem with gold is they were talking about rising interest rates, and today the U.S. 10-year yield hit 2%. Gold has no yield stream, and so when interest rates are at zero, fine. But as interest rates rise, the opportunity cost to hold gold is more. And I know that a lot of people are interested in this crypto space, and people thought that maybe crypto could be a good hedge against inflation. Hasn't proven to be so far, though it's a short history. And even now, people thought that, maybe Russia central bank, maybe individuals to try to hide their money or protect their money or get around sanctions by using crypto. And it looked like it could have been the case for a day or two, but as people dug below it, it looked like there really wasn't much there. People like myself maybe anticipated the Russians to do it, but there really wasn't as much activity as we had hoped for. And these days, by these days, I mean, say the last month or so, it seems that crypto is trading much more like a risk asset. Like, you tell me which direction the stocks are going, and I'll probably give a good guess about which way crypto is going.
Okay. So one last question that I have is recalling on what our Premier Mario Draghi said about a week ago, is that, of course, for the short term, we need to find new suppliers and so on, but we got to bet big for the long term on renewables. Do you think renewables all over the world are going to benefit on a long-term basis out of this situation?
Yeah, I don't think it's just this situation, but I think that this is like just pushing us in the direction we were going before. And I think that, of course, with oil price at $120 a barrel, it is wind, other renewables become a little bit more affordable. I think this is a serious thing. This is why I'd say two things broadly about this. One is that a lot of people I talk to think that what Russia is doing is putting the system to risk. And I don't see it that way. I see that what Russia is doing, Russia is being punished. It might be killing Ukrainians, and it might have a military victory, but it's being isolated and punished for breaking these norms, the international norms. So I think the system is stronger when a violator gets punished. And I think that what weakened the system is not Russia going to Ukraine now, but I think that what weakened the system is when Russia wasn't punished for past infringements, or when the US went into Iraq without the UN's permission. Also had all kinds of targeting problems, and of course the missiles of mass destruction or the weapons of mass destruction were never found. But the US did it with impudence, wasn't punished. And so I think that weakens the system. So on one hand, I'd say the system is stronger because the violator is being punished. But the second thing I'd say is that this is a big distraction. This is like 19th century geopolitics. I had hoped that after what we've seen in our lifetimes, in our parents' lifetimes, that we wouldn't have a war in Europe like this. And I'm afraid that this is like such a distraction from the big problems that we face. And I think the environment is chief among them. And part of that environmental issue, of course, is we're hardly done with the pandemic. And in fact, I just saw that in the U.S. the masks on airplanes are going to be kept in place for almost another month. We're not done with the pandemic. We've got these public health issues. We've got environmental issues, and some boys in the sandbox want a bigger piece of the sandbox.
Yeah. So I am done with the questions. It was really, really interesting talking to you today. You gave a lot of interesting perspective. If you want to add something else to your point of view, you're free to do so. If not, I really want to thank you for being with us today.
No, thank you. I think that the only thing I'd say is that, I sort of realize that most of what we talk about, trying to think about the future is like a hazardous, and we never really get it right. And I think about what in the US, we had an inventor, Thomas Edison, and he said once that he didn't fail. He found 10,000 ways it didn't work.
Yeah, that's right. That's right. So um, I would say this before I let you go. Make sure to not to put not to risk everything on the stock market in these days because it's very volatile. But it's great to have such a conversation and such these kind of perspectives for all of you that are investing in the markets today in these days. So thank you, Marc, for being with us. I really want to thank you again. So this is it for today. This is Hustle Hub. I'm Giacomo. See you next time.
Thank you.